There is a belief that traps more traders than bad indicators, bad entries, or bad timing ever will. It sounds reasonable, and that is exactly why it is dangerous. Most people think big moves begin when price explodes. They think the move starts with the candle everyone notices, the breakout, the surge, the panic, the excitement. They believe the market suddenly wakes up and decides to run. But that is rarely how important moves are born. The move you notice is usually not the beginning. It is often the result, and if you understand that one thing, you start looking at markets differently. Let me ask you something. Have you ever watched a chart all day, seen nothing happen, become impatient, looked away, and then suddenly price made the move you were waiting for? Have you noticed that some of the biggest moves seem to happen after periods that looked almost dead? That is not an accident, because markets have a habit that most people never fully understand. Important moves often begin quietly. The noise comes later. Now think about this. If large money needs to build a position, can it simply buy everything at once? Can serious capital enter the market the same way a small trader clicks a button? Of course not. If a large participant suddenly enters with full force, price moves against them immediately. Their own buying creates higher prices. Their own selling creates lower prices. So they have a problem. And hidden inside that problem is the secret behind big moves. The market needs time. Read that carefully. The market needs time because large positions need time. This is where people become confused. They look at a quiet market and assume nothing is happening. They think activity only exists when price moves aggressively. But underneath the surface, something entirely different can be taking place. Imagine a lake. From above, the water looks still, calm. Nothing appears unusual. But beneath the surface, strong currents may already be moving. The chart often works the same way. Now here is a question for you. Why does price sometimes repeatedly return to the same area without truly leaving it? Why does it look trapped? Most traders become frustrated there. They buy the top of the range. Price falls. They sell the bottom. Price rises. They get shaken out repeatedly. They call it manipulation. They call it random movement. But what if there is another explanation? What if that range is not meaningless? What if it is preparation? Because preparation leaves fingerprints. Large interests cannot hide everything. They can hide intention, but they cannot hide behavior. Behavior always leaves clues. Watch what happens inside these quiet areas. Look at how price reacts when it approaches resistance. Does it fall aggressively? Or does it pull back only slightly? Look at support. Does price collapse when pressure appears? Or does it absorb selling and stabilize quickly? These small details matter because they reveal something larger. Because creates effect. If selling pressure keeps appearing and price refuses to break lower, that tells you something. Demand is absorbing supply. If buyers repeatedly attack resistance and sellers cannot force price lower, pressure starts building, and pressure has consequences. Think of a spring. You compress it slowly. Nothing dramatic happens at first. You compress it again. Still nothing. Someone watching casually sees nothing interesting. Then eventually the release happens. Suddenly people react. Suddenly social media reacts. Suddenly everyone says, "Look at this incredible move." But the move did not begin there. The move began during compression. Now ask yourself another question. Where are most traders emotionally during these periods? They are bored. And boredom is dangerous in trading. Fear receives attention. Greed receives attention. Boredom quietly destroys people. Because boredom creates action for the sake of action. A trader watches a market sitting in a range and thinks, "I need to do something." So they force trades. They create opportunities that do not exist. They become active while larger participants remain patient. And patience has an advantage over urgency. Always. Because markets have a strange way of rewarding people who can wait while punishing people who need constant excitement. Now this leads us somewhere important. If major moves are often prepared before they happen, then your job changes. You stop asking, "How do I catch a move after it starts?" You begin asking, "What behavior appears before it starts?" That is a completely different question, and different questions create different traders. So what should you actually watch? First, watch for repeated tests. When price keeps returning to an area again and again, Pay attention. Most people think repeated tests weaken a level automatically. Not always. Sometimes repeated testing means pressure is building. Imagine someone pushing against a locked door. One push, nothing. Another push, nothing. Eventually something gives way. Price behaves similarly. Second, watch reactions. Strong markets tend to reject weakness quickly. Weak markets tend to reject strength quickly. Notice the speed of movement. Notice the character. Because character matters more than appearance. Two charts can look identical at first glance and behave completely differently underneath. Third, pay attention to participation. When volume expands at important areas, ask yourself why. Do not ask whether volume is high. Ask why it became high there, because context changes everything. A loud room means nothing by itself. A loud room during an argument means something entirely different. The market works the same way. Now there is another mistake traders make. They assume every big move comes from news. News creates movement sometimes, yes, but often news becomes the explanation after the move already had reasons to exist. Think about it. How many times have you seen news arrive and price barely move? And how many times have you seen news arrive and price explode? Why the difference? Because news alone is rarely enough. Conditions matter. Preparation matters. The structure underneath matters. A match only creates fire if something is ready to burn. Otherwise it dies immediately. That is why experienced traders spend less time chasing headlines and more time observing behavior. Behavior reveals pressure. Pressure reveals imbalance. And imbalance creates movement. Now I want you to consider something. The market constantly asks one question. Who is becoming uncomfortable? Because discomfort changes behavior. A trader holding losses becomes impatient. An impatient trader exits. Those exits become orders. Those orders become fuel. And fuel creates movement. Suddenly you realize the market is not only moving because people want to buy or sell. It is moving because people are being forced to act. That changes the way you see charts. Now you begin watching trapped traders. You begin noticing hesitation. You begin noticing failed attempts. You begin noticing quiet areas that seem unimportant to everyone else. Most traders believe the market becomes important when it becomes loud. They wait for wide candles, strong momentum, headlines, and excitement. They think the market begins speaking when price starts moving fast. But that belief creates a problem because by the time movement becomes obvious, something important has often already happened. The biggest moves rarely announce themselves at the beginning. They do not walk through the front door and introduce themselves. They arrive quietly. They begin during periods that most people ignore. Have you noticed how some charts seem almost lifeless before a major move appears? Price moves in a narrow range. Candles overlap. Nothing seems exciting. You watch the market and think nothing is happening. Maybe you even lose interest and move somewhere else. But ask yourself something. Is silence always empty? In trading, silence can be active. A quiet market is not always an inactive market. Sometimes the most important work is happening during periods that look unimportant on the surface. Think about large participants for a moment. If serious money wants to build a position, they cannot enter the market carelessly. They cannot suddenly place enormous orders without creating a reaction. Large buying pushes prices higher. Large selling pushes prices lower. They understand this. So what do? They work patiently. They build positions over time. They allow price to move back and forth. They let activity unfold naturally. To an impatient trader, it looks random. To a trained eye, it can look very different. Now here is where most people get trapped. When price stays inside a range for a long period, traders become restless. They want action. They need movement. They start entering trades simply because they feel they should be doing something. Have you ever watched yourself become uncomfortable during slow markets? Have you felt that urge to force a trade because waiting felt harder than acting? That feeling matters more than people realize. Because boredom changes behavior. A trader facing boredom begins creating opportunities that do not exist. Small candles suddenly appear meaningful. Tiny movements start looking like trends. Decisions become driven by emotion instead of observation. Meanwhile, the market continues preparing itself. Watch what happens inside these quiet phases. Price repeatedly visits certain levels. Support keeps holding. Resistance keeps getting tested. Buyers and sellers continue pressing against each other. At first, nothing seems different. Then something small begins to change. Price stops reacting the way it did before. Selling pressure appears, but the market does not fall much. Buyers step in faster. Weakness gets rejected more quickly. Small clues begin appearing. Most traders miss these details because they are waiting for something dramatic, but dramatic moments usually have quiet beginnings. Think of a spring being compressed. You apply pressure once and nothing happens. You apply pressure again and still nothing appears different. Someone watching casually sees no change at all. But pressure is building, and pressure does not disappear. It accumulates. Eventually the release happens, and everyone suddenly notices the movement. People point at the breakout candle. They point at the surge in price. They say the move started there. But that was only the visible part. The real beginning happened earlier, during the period everyone considered boring. That is why experienced traders learn to pay attention when others stop paying attention. They become interested when markets become quiet. They observe behavior instead of chasing excitement. Most traders think markets move because someone suddenly decides to buy or sell. They imagine large moves beginning with one powerful action, one massive order, one moment where money rushes into the market and pushes price in a new direction. It sounds logical, but markets rarely work that way. Let me ask you something. If you wanted to buy 10 shares of a stock, could you do it instantly? Of course. You click a button, the order gets filled, and you move on. Now imagine buying millions of shares instead. Can that happen the same way? Not really. The size changes everything. This is where many traders misunderstand what happens behind major moves. They see a breakout and think large money suddenly arrived. They imagine institutions or serious players waking up one morning and aggressively entering positions. But large money has a problem. The larger the position, the harder it becomes to enter without disturbing price. Think about it. If a massive buyer enters aggressively all at once, demand suddenly overwhelms supply. Price jumps higher. The buyer immediately starts paying more for the same position. The market begins moving against them because of their own actions. So they cannot behave carelessly. They need time. That is the hidden reality many people never think about. Large money often enters in pieces. They buy some, wait, buy more, pause again. Sometimes they allow price to pull back. Sometimes they even appear inactive. To the average trader, this looks like indecision. Price moves sideways. Nothing exciting happens. The chart becomes boring. But what if boredom is hiding activity? Because the market often looks quiet when important things are developing underneath. Have you ever watched price stay trapped inside a narrow range and wondered why it refuses to move? Have you ever thought, why isn't this market doing anything? Maybe the better question is this: what if it is doing exactly what it needs to do? Because large participants do not usually chase movement, they create conditions. Conditions matter. Strong moves need fuel. Strong moves need positioning. Strong moves need preparation. And preparation takes time. Think of constructing a building. People notice the finished structure because it stands high above the ground. But before anyone sees walls, windows, or lights, workers spend time creating the foundation. The foundation receives less attention because it is slower and less exciting. Yet without it, nothing stable can exist. Markets often behave similarly. The visible move becomes the final result. The invisible preparation comes first. Now here is where psychology starts entering the picture. Most traders struggle with waiting. Waiting feels uncomfortable because inactivity feels unproductive. People feel they should always be doing something. They believe more trades create more opportunities. So during these quiet periods they become impatient. They buy random breakouts inside ranges. They sell random pullbacks. They react to every small movement. And because the larger process is still unfolding, they repeatedly get trapped. Have you noticed how people often become most active when the market gives the least information? That happens because humans naturally want certainty. Silence creates uncertainty. Uncertainty creates discomfort. Discomfort creates action. But markets do not reward action alone. They reward observation. Most traders look at a sideways market and immediately lose interest. Price moves back and forth, candles overlap each other, and nothing appears to be happening. The chart feels stuck, it feels directionless. Many people see these areas as wasted time, but that reaction comes from a dangerous assumption. The assumption is that visible movement equals important activity. Let me ask you something. If you walk into a room and nobody is speaking loudly, does that mean nothing important is happening inside? Not necessarily. Some of the most important conversations happen quietly. Markets behave in a similar way. Sideways movement often creates the illusion that nothing is taking place. Price stops making dramatic moves, momentum disappears, and traders become impatient. Their attention naturally shifts toward markets showing excitement. But hidden activity does not always create visible action immediately. This is where people start misunderstanding what they are seeing. Because inside these quiet ranges, buying and selling can still be taking place on a meaningful scale. Pressure can still be building. Positions can still be developing. The difference is that price has not yet revealed the outcome. Have you ever noticed price repeatedly returning to the same area without breaking through it? It approaches resistance, pulls back, then returns again. Or maybe it touches support several times and still refuses to collapse. At first glance, it can look repetitive, almost meaningless, but repeated behavior inside markets usually deserves attention. Because markets rarely repeat actions without reason. Think about a tug of war. From a distance, you might only see a rope moving a few inches left and right. It does not look dramatic. It does not look exciting. But underneath that small movement, both sides are applying force. Neither side has won yet. Energy is still being spent. Pressure is still building. The market often creates the same picture. Buyers and sellers continue fighting for control, while price appears trapped in a narrow area. One side absorbs pressure. The other side keeps pushing. And here is the interesting part. Price itself may not tell the whole story immediately. Behavior tells the story. Watch how price reacts after small moves. Does selling appear and immediately get absorbed? Does weakness disappear quickly? Do pullbacks become smaller over time? Small details often reveal larger information. Most traders ignore these clues because they are searching for movement instead of searching for behavior. There is a difference. Movement shows results. Behavior reveals process, and process often matters more. Now think about what usually happens emotionally during these periods. People become bored. Boredom quietly changes decision-making. A trader watches price move sideways for hours or days and begins feeling frustrated. They convince themselves they are missing opportunities somewhere else. Suddenly every tiny movement looks meaningful. A small candle becomes a breakout. A small pullback becomes a trend reversal. Impatience starts creating stories that price itself never confirmed. Have you ever entered a trade simply because you became tired of waiting? Many traders have. Not because the market gave clear information, but because silence felt uncomfortable. That discomfort becomes dangerous because it pushes people into unnecessary decisions. Meanwhile, larger participants may still be doing what they were doing all along, building positions, testing reactions, watching pressure develop, preparing conditions. Most traders become obsessed with movement. They open a chart and immediately ask one question: where is price going? They want direction. They want speed. They want action. If a market starts moving aggressively, their attention locks onto it instantly. But there is a problem with that approach. Movement can attract attention while preparation creates movement. There is a difference between the two, and most people spend years looking at one while ignoring the other. Let me ask you something. If you see smoke rising into the sky, do you assume the smoke created the fire? Of course not. The smoke is visible because something underneath already existed. The fire came first. In trading, price movement often acts the same way. The dramatic move everyone notices may only be the visible result of something that has been developing quietly for a long time. But because people naturally react to what they can see immediately, they mistake the result for the cause. And that mistake changes behavior. Because if you believe movement itself creates opportunity, you will spend your time chasing movement. You will search for fast candles, sudden breakouts, and explosive activity. You become interested after excitement appears. Now think about what usually happens then. A trader sees price rising aggressively. Emotion enters immediately. Fear of missing out appears. The mind starts creating pressure. What if I miss this move? What if this keeps running? What if everyone else gets in before me? Notice what happens. The trader is no longer observing. The trader is reacting, and reactions usually happen late, because the market often rewards preparation while punishing urgency. Have you ever looked at a chart after a huge move and wondered why you missed it? You scroll back and suddenly see something interesting. Before the breakout happened, price spent time moving sideways. It stayed inside a range. It tested levels repeatedly. Earlier, that area looked boring. Afterward, it suddenly looks important. The information was always there. Only your attention changed. That is why preparation matters. Preparation leaves clues before movement arrives. Look at markets that seem quiet. Watch areas where price repeatedly reacts. Notice where sellers try pushing lower but fail. Notice where buyers keep returning even after pullbacks. These details may appear small, but small observations often reveal larger intentions. Think about pressure building inside a container. At first, nothing appears different on the outside. Everything looks normal. There is no visible explosion, no dramatic reaction, but pressure continues increasing, and pressure does not need excitement to exist. Eventually something changes. The release comes later. Most people only notice the release. Experienced traders become interested in the pressure itself, because pressure creates consequences. Now this does not mean every quiet market will produce a major move. Not every range becomes important. Not every pause becomes preparation. That is another mistake people make. They hear ideas like this and begin assuming every sideways market contains hidden opportunity. No, the point is not to force meaning into everything. The point is to observe behavior carefully. Ask questions. Is pressure increasing? Are reactions changing? Is one side becoming weaker? Is price behaving differently than before? Because behavior often shifts before movement does. That shift matters. Movement tells you something already happened. Preparation tells you something may be happening. Most traders wait for price to explode before they become interested. They wait for strong candles, fast momentum, and obvious movement because they believe movement itself reveals opportunity. But by the time pressure becomes visible, the market may already be showing the result rather than the beginning. The important question is not, when did price move? The more useful question is, was pressure building before price moved? Because major moves usually do not appear from nowhere. They develop. Let me ask you something. Have you ever shaken a bottle before opening it? At first, nothing dramatic happens. You shake it once, then again. The outside looks almost unchanged, but something is happening internally. Pressure is increasing, and the interesting part is this: you do not need to see the release to know pressure exists. Certain conditions already tell you. Markets often behave in the same way. Pressure can build quietly while price still appears relatively calm. Most people miss it because they only focus on what price is doing. They rarely focus on how price is behaving. There is a difference. Price movement alone only shows location. Behavior reveals intention. Watch what happens when price approaches important areas. Suppose price reaches resistance and sellers appear. What would you normally expect? You would expect a meaningful drop. But what happens if the drop becomes smaller than before? What happens if selling appears but buyers quickly return? What happens if price keeps coming back again and again? Something important may be changing. Pressure often reveals itself through reactions. Have you noticed that healthy strength usually behaves differently from weak strength? Strong markets tend to absorb pressure. Weak markets tend to collapse under it. Imagine pushing a heavy object. If you apply force and nothing moves, you assume resistance is strong. But if repeated pressure starts creating small shifts, you begin noticing something different. The object may still appear stationary, but change has already begun. Markets leave similar clues. Repeated tests matter. People often hear the phrase that repeated testing weakens support or resistance. Sometimes that can be true, but repeated tests can also show persistence. Imagine someone trying to push open a locked door. One attempt fails, a second attempt fails, then a third. From the outside, nothing changes, but pressure keeps being applied. Eventually the door becomes vulnerable. The market sometimes creates the same pattern. Price returns repeatedly because one side continues pressing. Now here is where psychology enters the picture. Most traders become impatient during these moments. They see sideways movement and assume nothing important exists. They want confirmation immediately. Have you noticed how people love certainty? They want markets to clearly announce direction. They want clean signals. They want obvious answers. But pressure often develops before certainty appears. That creates discomfort. Because humans naturally prefer visible evidence over subtle information. So they ignore small clues. They dismiss changing behavior. They wait for the dramatic move. Then once the breakout finally arrives, emotions suddenly become stronger. Now fear enters. Now excitement enters. Now urgency enters. And urgency often creates poor decisions. Because while everyone else is reacting to movement, experienced traders are often paying attention to the conditions that existed beforehand. They watch whether pullbacks are becoming weaker. They watch whether support keeps holding despite pressure. They watch whether sellers are losing control or buyers are losing strength. Because pressure rarely appears as a single event. It usually appears as a process. Most traders think markets move because people suddenly become confident. They imagine strong buying pushing prices higher or aggressive selling pushing prices lower. They believe movement begins because traders voluntarily decide to act. But some of the strongest moves happen for a different reason. Sometimes markets move because people are no longer choosing to act. They are being forced to act. There is an important difference between wanting to buy and needing to buy. There is a difference between wanting to sell and needing to sell. And that difference creates pressure. Let me ask you something. Have you ever entered a trade feeling completely certain, only to watch price move slowly against you? At first, maybe you stay calm. You tell yourself it is normal. You tell yourself the market will come back. Then price keeps moving. Now something changes. Confidence slowly becomes discomfort. Discomfort becomes concern. Concern becomes stress. And eventually stress demands action. This is where trapped traders begin appearing. A trapped trader is not simply someone holding a losing position. A trapped trader is someone holding expectations that the market is refusing to support. Because expectations shape behavior. Suppose a trader buys a breakout above resistance expecting strong continuation. Everything looks perfect. Price breaks above the level. Momentum appears. Excitement builds. More traders enter. Then suddenly price stops. Instead of continuing higher, the market slows down. Then it starts falling back into the range. At first, traders hesitate. They think it is only a small pullback. Then price drops further. Now uncertainty enters. Now the trade no longer matches their expectations. And this is where the situation becomes interesting. Because trapped traders eventually face pressure. They can hold and hope. Or they can exit. But exits create orders. Orders create movement. And movement creates consequences. Think of people standing in a crowded theater. Everything feels calm while everyone remains seated. But imagine someone suddenly shouts that there is danger. People begin moving toward the exit. Then more people move. Then urgency spreads. The movement itself starts creating more movement. Markets often behave the same way. One group exits. That exit pushes price further. Further movement creates discomfort for another group. Now more exits happen. The cycle continues. Have you noticed how markets sometimes move much faster after certain levels break? There is a reason. Those levels often contain trapped traders. People who expected one outcome suddenly face a different reality. And when expectations collapse, behavior changes quickly. This is why failed breakouts can become powerful. This is why false moves sometimes become stronger than real ones. Because trapped traders become fuel. The market feeds on imbalance. Now here is where many traders make a mistake. They spend all their time asking where buyers are entering or where sellers are entering. But sometimes the better question is different. Who is becoming uncomfortable because discomfort changes decisions? A confident trader waits, an uncomfortable trader reacts, and reactive behavior creates opportunity. Watch markets carefully around important levels. Watch what happens after breakouts fail.